Welcome to this segment of Chit Chat session with Ashley Church and Dave, powered by the Fund Master. Today we are in discussion with Ashley Church on interest rate market, where it has been in the history, where does Ashley think it will go, and also we'll talk about some loan to value ratios as to what bank is lending on in terms of 20%, 10% LVRs and stuff. So we start with our interest rate discussion first. What is your prediction on the interest rates this year, Ashley?
Well, before I talk about a prediction, let me just remind everybody about why interest rates are used the way that they are and the impact that they're intended to have. So it's important to remember that the Reserve Bank controls interest rates mostly. There are some exceptions to that, but they set something called the OCR, the official cash rate, which is a guide to the banks as to how much they should charge for mortgage interest rates. And that goes up and down. And it's gone down dramatically over the last few years. In fact, it got to a point where it was almost zero. And so that allowed the banks who use that OCR as a guide to offer very low mortgage interest rates. Now, it started going up again. Really important to understand why it's going up. The reason it's going up is because the Reserve Bank, which, as I said before, controls it, uses interest rates to control inflation. So, and that's not just New Zealand, that's pretty much the entire Western world. So when inflation is low, and we've had low inflation in New Zealand for quite a long time, the Reserve Bank targets between 1% and 3% inflation, then interest rates are low as well, because for two reasons. One, because there's no reason for interest rates to be high, but secondly, because the Reserve Bank wants to keep demand and sort of an appetite for lending going, and so it keeps rates low so that people will continue to borrow and fuel the economy. But when inflation gets higher, and we haven't had high inflation for a long time, the Reserve Bank uses interest rates to dampen demand and bring inflation down. It's a very simple causal relationship. It says that if inflation's high, the best way to reduce it is to increase people's costs, such as their mortgage, and then they'll stop going out and spending money on other things, and that will bring down inflation, because inflation's based on supply and demand. So the reason we've got interest rates going up at the moment is because we've got unexpectedly high inflation. So at the moment it's sitting at about 4.9%, so it's well above that 1% to 3% band, and there's talk it'll go as high as 6% or even higher. So the Reserve Bank will keep hitting it with high inflation rates until it starts coming down again, and then my expectation will be that they'll start looking at reducing interest rates again, the OCR again, as they've done in the past. So to put that in some sort of historical context, if you go back to the mid-80s, and remember in the mid-80s we didn't have this relationship between the Reserve Bank and interest rates, so it was a much more disjointed thing. But if you go back to the mid-80s, interest rates on mortgages were over 21%, or over 20%. They were up around that 21% mark. Imagine paying a 20% interest rate on your mortgage. And over that 40-year period between the 80s and now, those rates have come down. So they've come down gradually over the last 40 years. And what's interesting, and I'm very strongly of this view, is that you can argue that there's a very strong and tight relationship between the reducing of interest rates and the increasing of house prices, for the simple reason that if I'm paying less on my mortgage, I can afford a bigger mortgage. And that's what's happened. People have been prepared to pay more, and mortgages have got bigger, and so people have paid more for houses. So by historical standards, the rates at the moment, which are, and you'll have a better idea of where the current rates are, but they're higher than they were a year ago. They're still very, very low by historical standards. They're just higher than they were last year. Yeah. And I would expect them to go a little bit higher still, and then I would expect them to settle at that point for a while. And then once the Reserve Bank is confident that it's got inflation back under control, they'll come down again. So I wouldn't want to put a number on where that might land, except to say that if I were refixing a mortgage, I would take into account the fact that they're likely to go a little higher, and they may stay at that level for a while. But the long-term trajectory, in my view, is that they'll come down again.
Come down again.
Yeah.
Perfect. So interest rates might go a little bit up just to control inflation, and they will come down again in the long term. So people who are looking to fix interest rates for 12 months, 24 months, 3 years.
Yeah. You're the expert on that. I'd take your advice over mine.
Okay.
But
I'll say a split risk strategy. That's what I tell my customers.
Yep.
That we can't control the external factors.
Yep.
But I have a two-pronged approach that in today's market, you could have any calamity, any coronavirus from somewhere.
Yep.
They'll put an impact on the interest rates.
Yep.
But you could also have the growth.
Absolutely.
So it's going to be a pretty good mix. So having to know your own payments as to what you can afford, and then accordingly locking a long-term and a short-term strategy.
Absolutely.
You know that you are comfortable with the payment, because if the rates go down, it feels, yeah, I would have paid lesser, made more principal. But if they go up, you cry.
Absolutely.
So you could do a mix of that. In terms of interest rates, the prediction is pretty clear that they'll go up for now and they'll probably come down and stabilize when inflation is controlled.
The two unknowns in all this are how high they'll go.
Yeah.
None of us know. And that will really depend on what happens with inflation. And the Reserve Bank's got no control over how high that goes, only how much you can set interest rates at. And the other unknown is how long they'll stay there.
Perfect.
So how high will they go and how long will they stay?
How long will they go out this day? So it's not a crystal ball gaze.
No.
As I said, your budgets, your own budgets, when you sit with an advisor, anyone at Fund Master, or your own advisor yourself, or any government organization, there are a lot of budget calculations. Use those for your advantage. Know what you're spending, where you're spending. As the doctor says, read the label as directed. Read your budget as directed and direct yourself on spending money. Thank you so much, Ashley, for joining us
Very
for this
welcome.
interest rate session. And thank you, our viewers, for watching this chit chat session with Ashley Church. Thank you.